Welcome to Crypto Clarified, Investing in the Truth, a podcast series where we come together each month to discuss the most captivating headlines and trends from the investing in crypto space. My name's Benjamin Dean, I'm Director in Wisdom Tree's Digital Assets team, and I'm joined by my co-host, Camilla Russo, who's founder of Defiant Media, and our special guest, Drew Robinson, Head of Institutional Sales EMEA at Coinbase.
Cami, how are you doing?
I'm great, Ben. Thanks. Thanks for having us here.
Cami, you're on the road as well this week.
Mm-hmm.
What's taken you to where you are?
Well, this is, pretty wild. It came about kind of last minute, but I'm here to talk about crypto with the Pope on Thursday. So yeah,
Excellent.
Vatican NFTs.
Well, I can't claim that I'm doing anything nearly as exciting as that, but we also have another special guest this week, Drew Robinson, who's the Head of Institutional Sales EMEA at Coinbase. Drew, welcome. Thank you for joining us.
Thanks for having me, Ben. Excited to be here. Can't say that I'm anywhere nearly as exciting as Camilla being in Rome with the Pope, but nonetheless here in London. So happy to join you guys today.
Excellent. Well, in today's episode, we're going to cover a few different topics. It has not been a quiet week in the crypto and digital asset space, as if it ever is. But we're going to cover some events from the past week that I'm sure listeners will be interested in hearing our thoughts on. Luna and the UST stablecoin. What happened there? Then we're going to think a little bit about the broader macro environment in which we find the crypto space. All right, Drew. As I said, thank you for joining us. Could you just take a few seconds to introduce yourself to the audience, let them know how you got involved in the crypto space, what you first thought was like the big potential initially, and then we'll just go for it. Let's hear your experiences and your story.
Yeah. Thanks again, Ben and Camilla for having me. So Drew Robinson. I look after the core institutional sales team at Coinbase in Europe, the Middle East, and Africa for us. I've been with Coinbase now for the last just over 4 years, actually. So it's been a wild ride. Prior to that, most of my background is in traditional finance. So I started off trading interest rates at Lehman Brothers, and then 2008 happened, and that business dried up. Moved into cash equities trading and cash equity sales at several different investment banks. Took a break from finance and went into strategy consulting actually after business school. So that was in 2016. That's what originally brought me to London from New York. And it was at that time that I became involved in crypto. I was working in strategy consulting and spending most of my time in the Middle East, in Abu Dhabi, as well as sub-Saharan Africa, working with sovereign wealth funds as well as corporates. And a lot of these sovereigns or corporates had these core legacy positions within the oil and gas or natural resources space. And they were looking to diversify out of positions that were negative ROIC or whatever it may be into something that was a bit more growth. And so at the time, a lot of our recommendations were focused around investing in AI or in Bitcoin, really, like it really kind of existed at the time, kind of at scale. That led me down my own rabbit hole, so to speak, where I started trading crypto PA and thought that it was fairly interesting, but still didn't really kind of dig deep enough into it. Fast forward, I guess, 2 years from then, I was working on a pro bono case in Kenya with the telecom company that was involved or are involved in mobile payments. And they were having issues getting mobile payments adopted kind of at mass scale because a lot of the Kenyan economy is what's considered informal, right? So you go and you buy a piece of food or you buy a newspaper for a few bobs or for a few shillings, whatever it is, to pay using the mobile payments. It was too many steps. It was clunky. It wasn't great. And I remember a colleague at the time saying, we can probably tag these transactions using the blockchain. And then it kind of hit me again. And I kind of went back to the Bitcoin, the blockchain. And at that point, I started reading aggressively, subscribing to crypto Twitter and everything else. I decided that's what I wanted to do full time. So I left strategy consulting in January 2018 and decided to join Coinbase in London to help build out the institutional business in the region. So that's been my journey to date.
Nice one. It seems to be a common thread that we find often. We chat with folks in the space. They've gone out into countries, not necessarily where they were born or grew up with, travel a lot, and they see the different use cases for the technology and kind of see this potential in the background. Coming from management consulting then, if you could say like one thing, and maybe there's many, but let's settle with one. What's your favorite thing about having moved into the crypto space, given your background?
Yeah, it's funny that you said that because there definitely is a lot more than one. And to your point, kind of making that transition, kind of the entry point for crypto to me was trading, right? And then sitting in Kenya, sitting in the bush with Maasai warriors, it was them using mobile phones to pay for cattle, which kind of blew my mind. And so, like, I guess linking that to like why crypto is so different from management consulting or sales and trading or investment banking that I've been in. It's I mean, probably everyone would say the same thing, but it's just the pace of innovation, right? I've never worked in an industry where you're building as you're going in real time and kind of figuring out as you go. Whereas management consulting is kind of very much the opposite, right? It's kind of a tried and true using a frameworks or kind of benchmarks or whatever it may be to kind of arrive at a solution and kind of always going back to first principles. So kind of complete opposite in terms of organized chaos. That is the beauty of crypto, which I'm sure you two could relate to and kind of what you enjoy as well.
Nice, indeed. Well, as I said, it's great to have you. Speaking of organized chaos, or maybe just chaos, the last week saw really a very noteworthy event in the crypto space where trial and error is the norm and failures pop up from time to time. Last week saw the implosion of the Luna cryptocurrency, the UST stablecoin to which it was in tandem with as part of a peg. And then the Terra blockchain network was eventually turned off when dust had settled and everything had gone to zero. I mean, really a spectacular implosion. Billions and billions of US dollar equivalent disappearing within 48 hours. I imagine this caught a lot of people's attention, even those who don't follow the space very closely. But knowing one person who does follow the space very closely, Cami, if you want to try and frame for the listeners, like what Luna is, what UST is, and maybe just like a chain of events that unfolded quickly last week.
Sure. So, this Terra implosion has really been, I think, one of the biggest stories in crypto in a while. It's pretty historic what we're witnessing here. Just the crash of a project so big, so fast, I don't think we've seen before. And so, what is Terra? Terra is a standalone blockchain. It's part of the Cosmos ecosystem, but it's its own layer one. It has a volatile token called Luna and a stablecoin called UST. And this stablecoin is different from something like USDC, which is backed by dollars, by like fiat currency stored in a bank. It's different from DAI, which is over collateralized with crypto assets. UST is backed by the Luna stablecoin, and it's backed by an algorithm which controls the supply of UST in the market. And it's kind of this algorithm that helps it maintain its $1 peg. So it's part of this group of stablecoins called algorithmic stablecoins. So there's like a mint and burn mechanism where traders of the Luna volatile token are able to redeem $1 worth of UST whenever the peg goes above or beyond. So that arbitrage is supposed to bring UST back to peg. So the problem here is that this system really depends on Luna having a value at all. Because if there's, even if you're redeeming for trillions of Luna, if Luna is worth zero, then there's nothing to hold the UST's value. And that effectively is what we saw happen last week. There was, this was obviously in the context of just like a broad market sell-off, not just in crypto, but everywhere. Markets and especially risky assets started selling off. Luna price was crashing. That spooked traders. There was some kind of big sell orders of UST And then, you know, that led to UST losing its peg somewhat on Monday. And then things just spiraled. When people saw that UST was below its peg, Luna continued to sell off. UST started to fall further below its peg, and it was just like this bank run, really, this spiral of death. And so, you know, some of the remedies that happened were the Terra community, led by Do Kwon, the founder, decided to increase inflation of Terra to back, inflation of Luna to be able to back UST. And it was just incredible watching Luna supply just like skyrocket into the trillions. But you know, that didn't help. Then there was the Luna, the Terra Foundation selling off billions of dollars worth in Bitcoin, which it had as reserves in case something like this happened. That didn't help. Has proposed forking the Terra blockchain, basically starting over without a stablecoin in this case. So kind of like scrapping this kind of algorithmic stablecoin idea for now. And the market is still grappling with this. We're still kind of seeing the ripple effects with algorithmic stablecoins across the board, just like going off their pegs as well, because people are losing confidence in this entire sector of crypto.
Nice, indeed. Algorithmic stablecoin, relatively experimental ideas, uncollateralized. And you mentioned that there's still ripples going out through the ecosystem. This US dollar pegged token segment, the stablecoin segment, grew from roughly $6 billion to $160 billion over 2021. So it's come to be a major portion of the market. Drew, I wonder if you've got any thoughts there about, like, having watched the events last week and having been someone who's followed this space for a while, what do you think was kind of, we know the chain of events that led to the unwinding of the network and the currency, but what could have been behind it?
Yeah, I think that. Well, I think a couple of things, right? I think taking a step back in terms of like some of the lessons learned. It's one, you know, when a project or a stablecoin tries to act as a central government, right? It obviously didn't work out this time. You realize that you don't have the taxing power of government. You realize you necessarily don't have the military power to kind of reinforce some of these pegs, or like I said, the actual kind of raw assets that are sitting behind them, right? So in some respects, it was a lesson 101 in economics, right? Kind of going back to first principles. Outside of that, also it was for the stablecoin sector, like liquidity and solvency concerns became really, really apparent, right? And so I think that, like, in terms of what was happening, is that there were people that were looking out there, either retail investors, institutional investors, and obviously there was rumors circulating who could have been behind it, and some of the names that were floated just didn't make sense, and we can talk about why they didn't make sense and the various reasons. But people saw an opportunity, obviously, to exploit the arbitrage and kind of continue to weaken the project, right? And anytime you're in unprecedented markets like how we are now from a risk-off scenario, what you see is kind of the wolves that kind of go hunting for like the next weak prey afterwards. And as Cami mentioned, next was kind of Tether, which, although the mechanism behind Tether is very different, you saw the DPEG right on Thursday, which prompted the CTO to come out and provide a bit more transparency around like the reduction that they've done in the last few months over their exposure to commercial paper, swapping that out for treasuries. And then you kind of also then realize, you start to say, okay, well, you know, if you believe the accounts for Tether, then it really becomes almost impossible that someone's going to be able to, you know, borrow $40 billion or whatever it might be that they have in USD to be able to start to break that peg. But very quickly, you just, in opportunistic markets, you see people looking to go to the next kind of weakling, similar to like the 2008 financial crisis, right? It started off with one bank and then on to the next. And that's what we saw kind of going through the stablecoin sector. But I think zooming out, the kind of key message here is that not all stablecoins are created equal, right? That's the key to take away.
Absolutely. So what's interesting is, in a space where people worry a lot about hacking and cybersecurity challenges, actually good old economics, demand and supply, almost a bank run dynamic. I wrote a note this week that people can find on the Wisdom Tree website. sharing my thoughts on the event, and the title I chose was "A Depegging That Soros Would Be Proud Of," in an allusion to Soros going after the Thai baht and the Great British Pound. I mean, all that's happened here is you've moved these systems onto crypto rails, but it's the same force of economics, demand and supply, are still there. And so going forward then, Cami, you mentioned like this sent shockwaves throughout the stablecoin segment, and folks are worried about the segment like continuing to exist. What lessons can folks take away from this in a world where not all stablecoins are created equally, and in a world where there is just tremendous demand for these kind of crypto US dollars?
Yeah, I think the key takeaway is to, is investors should be aware of how the stablecoin that they're holding is structured, because something like Terra, if you look closely into it, you could see that it's backed by this very volatile token, Luna. It's not over collateralized. It depends on demand for Luna. And so, you could conclude from that demand for Luna doesn't necessarily always have to be there, like it wasn't last week. But then something like USDC or all the other kind of fiat-backed stablecoins have a much lower kind of degrees of risk. Like you can see kind of statements that show that they are actually backed by dollars in the bank, that you can redeem one USDC for one US dollar, or at least kind of I don't think kind of any retail USDC holder can, but the issuers can. And so on. There's different degrees of risk that you can take as an investor. With Tether, it's true that it's been under a lot of kind of skepticism and scrutiny because of the fact that they once claimed that they were fully backed by US dollars, but then after an investigation surfaced that showed that they actually tethers weren't fully backed by US dollars, but still it's about 70% backed, 70% backed, and with a combination of US dollars and treasuries and commercial paper. So you can kind of assess the degree of risk that you want to add to that. But I think, maybe to use Tether can be worth 0.99 cents, but I don't think in any case anyone would think that it's a lot anything lower than that. And so, yeah, I think that's the key takeaway, that not all stablecoins are created equal, but that there are some reliable stablecoins that traders can rely on to play in the crypto market, and that's a very important that's just like a very important piece that traders can rely on, because right now stablecoins do account for the majority of trading in crypto. So if there was any kind of real doubt that stablecoins aren't safe, I think that would completely undermine the entire space. But again, I don't think that's the case. The Tether USDC, even DAI, all of those stablecoins are several degrees of magnitude safer than something like USD and some other under collateralized stablecoins.
Exactly. So collateralization is important. Transparency is important. Sometimes a regulated entity will be issuing these things. That doesn't mean an algorithmic stablecoin is bad in of itself. Make a DAI is over collateralized as an algorithmic stablecoin. So you've got to kind of do your own homework as always, but as you say, they're not all created equally. I do notice the USDC stablecoin is eating market share off Tether. And I know who issues the USDC stablecoin, that's Circle. They're fully audited financial statements. I also know Drew, being at Coinbase, will be within 1 degree of separation from all of that. Drew, you folks at Coinbase think a lot about this. I know you list a few different stablecoins, and I also know that you think a lot about regulations, which is probably going to be one of the big major changes that comes out of this Luna UST incident. Do you have any thoughts you want to share around USDC, around collateralized stablecoins, and maybe the regulatory implications of what we've seen last week?
Yeah, I think that just like, with USDC overall, first and foremost, it's always been, let's make sure that we're super transparent in terms of, the assets that are backing, make sure that it's the right kind of legal language there, that it's held in, to your point, regulated bank accounts that are onshore in regulated jurisdictions, right? So it's always been that highest level of transparency possible. The statements, the accounts are audited on a monthly basis. You can find them on the USDC website, et cetera. So again, I think that, Coinbase's ethos is always to be the most trusted and easy to use, right? And with that trust comes like that level of security and comfort, right? So always being able to raise the bar and be as transparent as possible. And then hopefully by doing that, getting others in the industry to at least meet us at the bar, if not set it higher. To that point, I think that when it comes to the likes of Tether versus what happened last week with USDT and Luna, I think that also, just given the size of Tether, like you said, USDC has started to gain market share, is that there's a lot of vested interest from the crypto community also for Tether not to go up, right? I think there's a lot of exchanges, et cetera, that would need to step in if that peg, to Cami's point, ever did break down kind of below the 99 cent, 98 cent level, whatever it may be versus the dollar. So I think that's super interesting in terms of when you do have that scale and that size and you become too systematically important to fail, what would need to happen. And then I guess, Ben, just to your third point in terms of regulation and transparency going forward, I would like to think that it changes. I just don't know like necessarily at what speed or what pace that it changes, right? Because even after a lot of the fear and kind of uncertainty that developed around Tether over the last, call it 18, 24 months, you still had Luna kind of come out, right, and gain a sizable amount of market share, a sizable amount of assets that were allocated towards it. So I think that, we probably unfortunately need to wait until there's very clear and cut regulation that's at a global level, not necessarily, coordinated policy, but at least kind of from the major jurisdictions where these projects are springing up from and where assets are held, that, at the end of the day, even if it is decentralized to some degree, there is a person or group of people that can be liable behind these projects. And so I think that's probably longer term to play out. I wouldn't potentially be surprised, if before we kind of get clear regulatory guidelines and lanes that, there's another project that can come out that this may happen in. And so I think it goes right back to that point of kind of doing your homework and making sure you understand, because right now we're in a down market and everything looks depressed, and there's going to be a lot of things washed out outside of Luna probably in the coming weeks and months, and then we'll get into that next hype cycle, and that'll be the next thing that kind of gets everyone excited, and we'll be here again in some, maybe not necessarily stablecoins, but some other look or form that's familiar. So I think that, again, kind of going back to my original comment in terms of the pace of innovation, which gets me excited about this sector, and kind of assembling things in real time. Unfortunately, I think that as that continues to outpace regulation until we kind of get regulation to keep up with the sector, these kind of stops and starts may unfortunately keep happening. And it just kind of comes down to making sure you kind of have a 101 understanding of what you're investing in or what you're allocating your capital towards, and going back to, some of the basics when it comes to economics. We're seeing economics in a tokenized kind of new digital form, but some of those fundamental principles hold very, very true.
Absolutely. Well, the US Department of the Treasury released a paper on stablecoins last November. The UK Treasury has said that they're going to bring stablecoins under the existing regulatory umbrella. I just suspect those administrative actions now pick up pace. In any case, listeners should check out the defiant.io. There's tons of articles there, all up to date, looking at this issue. You should check out my note as well at wisdomtree.com. Deepeg and Soros would be proud of. For all of the latest on that topic. Drew, you were saying that everyone is super depressed right now. I'm not depressed. I feel okay. It's true that the last 6 months have not been the most exciting, certainly not nearly as hype-filled as the previous 6 months. In finance land, they call this risk-off sentiment. And we've seen basically since December of last year through to recent months that the digital asset markets have kind of been contracting as the whole market. Can you kind of run us through from where you're sitting and people you speak to, some of the reasons you think that this is occurring, some of the reactions, maybe some of the reasons that you think folks are getting so pessimistic? Because I think that'll form a basis for us to trace out what the space might look like over the next 6 months.
Yeah, I think that's a good point, right? Kind of like, I guess, taking us back to the previous 6 months to see where we're coming from is that, kind of like year to date, thinking about it from that perspective, is that crypto markets really are in the midst of like a cyclical downturn pretty much. And I think that this started in earnest probably December of last year, right? So a lot of that is being carried on, for kind of lack of better words. And we're stuck between the macro environment, right? So crypto has now kind of been placed neatly inside of kind of all assets, and it's not uncorrelated. We come back to kind of that argument, but within the macro environment today, it's kind of the weaker global growth, particularly hitting regions like Europe, UK a bit harder, as well as higher inflation, right? That we saw. We saw kind of the print come out above 8% last week in the US, right? So with that being said, like 2022 has just so far been really a carryover of what was happening late last year. And like from a crypto specific perspective, that's been like the rise of like the alternative like layer ones. It's been like the explosion in NFTs, right, that we've seen. It's been like the Web3 build out and kind of the hope for the US improving a BTC ETF. So I think that one of the issues, Ben, like from a crypto perspective, is like we haven't seen that narrative shift, right? So there's been no extra juice in that macro backdrop to get people excited about the space. One thing I did come across that was pretty interesting, one stat that came across, was that institutional flows into the space have still continued at pretty good rates, right? So the block put out a report, and it said that venture funding that was received from the crypto space in Q1 of this year was at 12.5 billion, right? So up 20% from Q4 of last year. So I thought that that was interesting, and I'm sure those numbers are probably going to come down, but there's still institutions allocating to the space. So I think that kind of framing that in terms of what really happened the last few weeks in crypto, it's been, one, not much has changed from a narrative perspective from what we've seen last year in a really tough macro environment. So now you have this super liquid asset class, and then what we've seen, what that's translated to, has been like indiscriminate selling across the board, right? And that doesn't matter if you're like a macro, hedge fund, a VC, a family office, across all the segments we deal with. That's what we've seen. Kind of moments of capitulation without sounding too dramatic, right? Now we're holding up around the 30,000 level, but at the same time, crypto, or kind of Bitcoin in particular, is at this all-time high correlation versus the U.S. Equities, right? And so I think that we're kind of in a situation where most likely, kind of, I guess, optimistically, would be kind of range bound a bit for the next few months between 30 to 40,000, or kind of, worst case scenario, if equities continue to drift lower, we can easily see the asset class obviously dip lower on the back of that. So I think that that's, where we've been kind of year to date, some of the lessons that have been learned. And then, I think that kind of on the flip side of that, and then kind of hand it over to you, or happy to keep going, talk about like, what does that mean for the next 6 months to come in 2022?
Yeah, it's true. Crypto doesn't exist in its own island anymore. It's now kind of more interconnected with not just the traditional financial system, but kind of global economy. And so it's not surprising that we'd see kind of these interactions. It is interesting that equities are being pulled down, bonds are being pulled down. So goodnight 60-40 portfolio, tech stocks are being pulled down, like everything but commodities is getting hammered, even if digital assets are not equities or commodities. So I can see why folks on the outside would be getting so gloomy, but I'll tell you who wasn't gloomy. It was the 5,000 open source developers I met I didn't meet them, but they were around at the Ethereum Amsterdam Dev Connect a few weeks ago. They have plenty of funding that they've received from venture capital. And I think that that's an interesting contrast between this kind of gloomy financial asset class look at this, and then the actual people on the ground building things. Cami, I know that you spend a lot of time around the Ethereum community. I know that you track the DeFi and NFT segments a lot. Are people there nearly as depressive as Because they seem to be very optimistic. And why are they optimistic?
Well, I think it's important to in bear markets look at what builders are doing, and that just gives you a great signal about where the space is heading. I always kind of tell this this anecdote on when I was writing The Infinite Machine. So I wrote The Infinite Machine in the middle of kind of this really long crypto winter of 2018 and 2019. And I remember I went to kind of quit at Bloomberg in January of 2019 because I wanted to finish writing The Infinite Machine and become an independent writer and so on. And one of kind of the older reporters pulled up the ETH chart, which was like, I don't know, below 100 at that point, I think. And he was like, really? Like, you're writing a book about this? But, I was really confident about what I was doing because I was going to all the conferences and all the meetups and just seeing how each meetup and each hackathon had more people than the previous one, and seeing kind of all the projects that were being built. I mean, it was a time when DeFi emerged, 2018, 2019. So we're seeing kind of the same thing happening now. Yeah, like prices are down, but true builders aren't going anywhere. So ETH Denver had like 8,000 people. The Dev Connect event in Amsterdam had 5,000 people. There's going to be ETH New York in June, NFT NYC. They're expecting also something crazy like 10,000 people or so. I don't know. So yeah, I think, if there's like one bright spot that you can look at is these kind of Ethereum and other layer ones hackathons and what developers are building there.
Yep. And as you say, like the DeFi applications that formed part of the wave of DeFi summer 2 years ago were all being built in the crypto winter in 2018. So sometimes the builders need things to be quiet so they can actually build things that are useful. And maybe that's why they're so happy now. There's less hype and they can just get on with what they like doing. That's building things. Drew, I noticed that Coinbase has added some DeFi integrations this week. I like to see things like that because it basically takes what used to be a difficult thing to do, engage with DeFi, and puts it in people's hands in a way they can use. You want to tack on any thoughts about kind of products you guys are releasing and what it might mean for DeFi adoption, or in terms of having some positivity in a space where prices are depressed?
Yeah, I think obviously limited on what I can say from like a product roadmap perspective, but there's obviously been some great developments around things like Coinbase Pay or whatever, kind of integrating seamlessly into the various wallets, like from an SDK perspective and our commerce offering. There's been a lot coming out as well, as you mentioned, kind of just like linking the Coinbase wallet to the DeFi universe. And I guess like what I will say is that, again, like I hate to like keep emphasizing this, but I think it's important because all of us either haven't been in crypto for the amount of time that we have, or coming from traditional financial markets, these cycles are somewhat normal. And so to your point, Ben, I think you flagged it earlier. That was pretty interesting. Is that I'm not so much depressed. I think that was one of those things like where last week I was in Madrid for a conference and I was speaking on a panel at the same time as Luna and everything was transpiring in real events, and getting kind of peppered with these questions that I didn't even have time to like digest, right? Because I was kind of on the panel as it was happening. And to me, like when I got off, I kind of saw what was happening in the price action. I was surprisingly calm. And I guess this is like probably like my third or so crypto cycle or so. And so I think that like when you have like unprecedented times, all assets, as we know, go to like a correlation of one. And like what I come back to is like, you have to respect the market in terms of whatever that market may be that you're operating in. And that means, being patient and being tactical. And like right now, I just suppose that we're in a period where, we have to wait for consolidation, right? And I don't know exactly when that'll come, but it will come. And that will present opportunities. And then again, also like wash out a lot of the froth. And to your point, there's a lot of great teams out there. I know specifically for us, like our product teams are internally working heads down, right? And so what we've seen time and time again is that these downturns are a great chance to learn, right? It's like what I would encourage the audience to do, or for anyone to do. People, a lot of my friends included, after they got tired of hearing me betting on and being like the crypto evangelist, are like, well, it's at 40,000, it's at 60,000, and we missed the cycle, right? Or like, when's the next time to buy? And like that time may not be today, but you now have it a lot closer to where you wanted it versus when we were at 40, 50, or 60,000. So like I encourage people to kind of learn by doing, right? And so to your point, download Coinbase wallet, download MetaMask wallet, whatever wallet it is, and kind of play, put through a trade with a decentralized exchange, go out and buy a cheap NFT. They've gotten cheaper now, and then move into your wallet and see how it works. But I think that crypto winters are great. And like, what do we always say for a company is it really kind of allows for real work to be done, and kind of for the advancements in tech to be made. So, like looking at your portfolio, look at the price action, you don't feel great, but kind of knowing what will come out the other end is pretty exciting.
Indeed. The space is for people who didn't turn up yesterday. They've been through these kinds of cycles before. In fact, we've seen plenty of outrageous things over the years, so tolerance for these things is a bit higher. I could see why folks who turned up recently see events like the past week and it sends kind of a shudder through them. If you step back and you take a look not just at the broader macro picture where everything's getting hammered, then you also think through like there's plenty of folks going and building, and whatever they build is going to form the next set of opportunities in this space. The space is much bigger than Bitcoin, and that wasn't true 4 years ago, was it?
Thank you for listening to part 1 of our latest Crypto Clarified podcast. Stay tuned for part 2, in which we'll be tackling key educational topics, as well as debunking some of the popular misconceptions around cryptocurrencies in our Crypto Myth Buster session.